Now back here, Dr. Robert Shiller, creator of the Case-Shiller Index and longtime Cassandra, says exuberant markets could be on a precipice and in fact facing a bear market. Now that may send shivers down many a spine for cashed-up value investors like my next guest Roger Montgomery, but it's enough to make mouths water. Roger Montgomery, welcome back. Now,
always a pleasure.
You have been catching up with Dr. Doom's thinking.
Robert Shiller.
Robert
indeed.
Shiller, yeah.
Indeed, for an online journal called the Project Syndicate, he wrote an essay entitled The Coming Bear Market and finished the title with a question mark.
Well, I was going to say, even a clock is right twice a day.
Yes, indeed.
And Dr. Shiller is famous for his Cassandra approach, isn't he?
Yes, and to be fair, though, earlier this year and late last year, he was sanguine about the market. He said, look, it doesn't appear that we're at risk of any imminent collapse. But in the essay that was published only a few weeks ago, he decided to examine the Cape-Shiller ratio, which is...
Okay, so this is really interesting. That's cyclically adjusted price to earnings.
Correct, cyclically adjusted price to earnings. So what Robert Shiller does is look at the real stock market index, so adjusted for inflation, and compare that to a 10-year average earnings number. Now, why do that? Because it looks through the business cycle. That's the theory. And so you're looking at that's why it's called the cyclically adjusted price to earnings ratio.
Which now, you as a value investor would love.
Oh, we're very interested in his work. We currently are holding depending on the fund, between 47% and 23% cash in our funds because we can't find a lot of value. That, of course, doesn't mean that we're at imminent risk of a collapse, but we're interested nevertheless in what Robert Shiller has to say. Now, what he did is he investigated the media's attachment to this idea that a 20% fall in the index, the S&P 500, is a bear market.
Right.
He couldn't find any source to confirm that is in fact, he couldn't work out where the media got that definition from, but nevertheless he took it.
Sounds pretty bad though. Sounds like a bear market,
It sounds bad enough. So he took that number and he said, well, we need to define it better, and so we'll look in the last 12 months peak and we'll compare the market, and if it's down 20% from the peak of the last 12 months, then that's a bear market.
Because there have been times when the market's fallen, but over a longer period.
A much longer period, indeed. And there were 13 of these bear markets, defined this way, since 1871. And what he noticed was that the Cape-Shiller, in all but 2 of those 13 examples, the Cape-Shiller was above its long-term average of 16.8. In fact, currently it's at 30. So the first, in fact, indicator that we're in a territory that precedes, or an area that preceded a bear market's in place. We've got this very high Cape-Shiller PE, and it certainly was the case in 11 of the last 13, which, by the way, included 87, 2000 and 2007. Now, a lot of analysts are saying that what's interesting about the present situation is we've got very high earnings growth. And in fact, what Shiller noted was that in all of the last 13 bear markets, prior to them occurring, there was very strong earnings growth as well. And in fact, in the 2007, prior to the 2007 correction and the 87 correction, and even the Great Depression, the 1929 crash, we had above average, very strong earnings growth.
So he does also acknowledge, though, just to take the other side for a moment, that there were these sorts of Cape-Shiller sort of registrations very high, not followed by a bear market.
Well, that's what he didn't do. He looked at all the cases where the bear markets occurred and noted that the Cape-Shiller was very high. What he didn't look at is what you are referring to, which are called the false positives. That's where the Cape-Shiller was very high and it wasn't followed by a bear market. So he didn't look at those, or he didn't discuss them in the essay.
But they do exist.
Presumably they do exist. But what's interesting is that the combination of very high earnings growth prior to a correction and very high Cape-Shiller PEs prior to a correction, which exists today, existed before all of those 13, bar 2, those 13
so the market doesn't seem to be interested in this sort of
No, and in fact it's so disinterested that the volatility is obviously very low. No one's in fear at all of an imminent correction. In fact, I would argue that people fear missing out much more than they fear losing money right now.
Hence the market keeps going up.
Keeps going up, and we've got this very low volatility. Now Robert Shiller addressed the very low volatility, and in fact, in all 13 cases, we had lower than average volatility just before the bear market as well. And in fact, prior to the 1929 crash, we saw volatility that was lower than it is today. So none of these conditions, high earnings growth and low volatility, none of them rule out the possibility of a bear market. He does concede that we could be a year or two out before it occurs, but nevertheless, he says that the risk of capital loss is very high, and that's how he concludes the essay.
Yeah. Well, of course, you guys being value investors as opposed
Yes.
to the index fund, the passive investment stuff, you'd be all dying for this to happen, really.
Well,
I mean, in a way.
Well, certainly with a lot of cash in our portfolios, we're looking for it. What we've noticed is we're finding it very frustrating that there's not a lot of value at the moment, but when we look at high-quality businesses like CSL, we notice that on every valuation metric, CSL is well above its historical average. And then when we compare CSL to its peers and look at the average of the difference between CSL and its peers, we also notice that CSL is well above its historical average. So we sold CSL some time ago believing it was ridiculously expensive. It's now even more expensive. So as value investors, we tend to cry wolf far too early.
Yes, leave something for the other guy.
We're the guys not dancing. We're standing at the door waiting to leave first.
Yes.
And we've been dancing on the inside near the door for some time now.
OK, all right. Let me go to that one other subject that
Yes.
you've been looking at, and that's sort of, I guess, Amazon, Alibaba, but also the logistics side of it.
Yeah, so what we notice is that where Amazon has launched where populations are extremely dense, for example in London, it does very well, and it does huge damage to incumbent brick and mortar retailers. But where distances are much greater, and I've just come back from a holiday in Canada where distances between venues are very, very long, just as they are here in Australia, then brick and mortar retailers seem to survive. Now, there's a
So Amazon hasn't penetrated as much in Canada?
It's penetrated online sales, but it hasn't really decimated the brick and mortar retailers the way it has elsewhere. And so in Australia, we think that after a couple of years, Amazon might take maybe $3.5 or $4 billion of retail sales, which would amount to about 20% of online sales, but probably about 1%. It really is 1 or 1.5% of total retail sales, and certainly less than 5%, even if you take out the $75 billion of sales of Coles and Woolies, it's still going to be less than 5%.
So you think all this chicken licking thinking about Amazon down here is just that?
There will be some damage to margins because their algorithms which bring lower prices will affect everyone.
Yes.
But in terms of market share, it won't be the behemoth in Australia that many expect it to be.
Yeah.
And that means that there could be opportunities in the likes of Harvey Norman and JB Hi-Fi, which have fallen 25 or 30%. What's interesting is when we analyse where companies in the US, for example, have survived the Amazon onslaught, which is home improvements, so the Nick Scali's of the world and furniture retails. Amazon's not interested in shipping heavy sofas.
Yes.
And in auto sales, auto parts, where mechanics, for example, need a very wide range of parts delivered immediately, Amazon doesn't seem to be penetrating there either.
Roger Montgomery, thank you very much for all that.
A pleasure.
And after the break, Myers' venerable outgoing chair unloads on Solly Lew. Not going to take criticism of his leadership lying down, it seems. The Australian's Eli Greenblatt has the details next.